Right now, we are live on Facebook for the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because of his genius concepts, because of the ways he generates cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Gregg.
That is me. That is I. I am here, and I am GC.
And
Thank you.
You are GC. You're the Gist of the Cist. And with us today also, who is part of the team, Madison, our community manager. She is hanging out with us. She's going to handle anything you need in the chat. Just let her know. Madison, say hello to the people that are your fans.
Hello, everybody.
Madison, you want to tell that quick story about you going out to some of the real estate networking groups locally?
Just about to get into that. So I went to a Connect event, and of course, you guys have only seen me a few times, but a few people came up to me and were like, "Hey, you're Madison, you're Gregg's girl." Completely threw me way off guard. I was like, "Oh, hi, yeah, that's me. Nice to see you guys." So super cool to see that you guys are carrying things over and listening and actually noticing me. I mean, the red hair kind of gives it away, but pretty cool.
Well, it's another example of in real life happening, right? This show, this community, right? And Madison is here to stay. She's going to be a great resource for all of us here for the Not Your Average Investor Show community. So we thank you for everything that you are doing and helping this community grow.
Yeah, Madison,
I appreciate it.
welcome to celebrityhood. There's no going back.
Oh, no.
And speaking of welcomes, y'all ready for the roll call?
Game on.
Let's do it. All right. Madison's already welcoming everybody. Carl Thompson, good morning, everyone. John Henning, good afternoon, all. Nadeem Shah, hello, everyone. Good morning, good afternoon. Michael Kubata, good morning, everyone. Lee Bishop, the MVP of the Not Your Average Investor Show community. Great afternoon. Hello, Madison. Danny Davis, looking dapper, gentlemen. Thank you, Danny. I bet you look dapper yourself.
Thank you, sir.
Thank you, sir. Thank you, sir. Noah Randari, hello, everyone. Greetings from California. Joanna's in the house. She's saying hello. She's back. We got Nadeem. Oh, Nadeem is saying hello. Drew Barnhill. Good afternoon to everybody. Who else? Scrolling through. Rick Carr. Hi from Virginia. Rick, good to have you. That's your name?
Dare we say a new name?
Are you check in? Let Madison know you're new, so you
New
get an
name
official
alert.
welcome. And if you're not new, just let us know and I'll feel terrible about it. Marilyn Cotterman says, my family. You know where she's from? She's from Homosassa, Florida.
I think that's the home of the manatees.
Home of the manatees. That's
Yeah.
where you swim with manatees. All right, who else? We got Leonard Lee in the house. Good morning, everyone from Googletown, aka Mountain View, California.
There you go.
Leonard knows exactly where we are right now.
Yeah,
He's got the Google Maps. He's got the thing.
there you go.
All right. Bridget Nannon says, was the client call recorded yesterday? Welcome, Bridget. Yes, it was recorded yesterday, right? You should have received it if you're in.
I don't know if the email's gone out yet, but it will be going out shortly. Did it already go out, Madison?
I think Kate scheduled it for today, but I can always double check, make sure it gets out to them.
All right.
Love it.
Cool. Gregory Stone from New Jersey. Howdy to you, Gregory. Greg, past guest investor of the show.
And awesome.
Did a great job.
Owner of an awesome name.
And owner of an awesome name. And Bridget's checking in from Colorado. She hadn't said it before. Welcome, Bridget. Noah's sister Edith is also in the house with us. Edith, welcome to the show. Happy to have you.
Welcome, welcome.
We got Bill Shields. You know what he says? He says, Buenas tardes, damas y caballeros.
Love that. Love that.
We got our returning regular Rosalind
I
Riley.
was just going to ask about Rosalind, if she was returning or not.
She's back from Marietta,
So
California.
happy to see you.
We
Rosalind.
got Winston Alejo. Good to have you, Winston. He says hello. Who else? Sean Hanna. Good afternoon, everybody. Good afternoon, Sean. Peter James from the esteemed. Oh, Peter James and John. He's got a friend there too.
All right, John.
From the esteemed Commonwealth of Virginia. Good to have you in the house. Gene Ferreter is in the house. He says Gene Ferreter here. Good to have you back, Gene. Haven't seen you in a minute. Vivian Brick. Hello from Cali. Vivian, welcome to the show. Happy to have you. Ken Moline and Carolyn Moline, the patriarch and matriarch of the first family of the Not Your Average Investor Show community, are here. Man, this is a good one. Sergio Preto says hello. Hey, everyone, with 2 gator emojis.
Love that.
Love that. Go Gators. And that's it. Long roll call today. Happy to have you all in the house. If you are listening on the podcast and you want to be part of the roll call, you want to hear your name, stop fiddling around and just join us live. Go to NYAS.com, be part of the community, join the show. It's as fun as it sounds. And now what we are going to do is kick off the official programming as Gregg teased before the show. Every quarter, JWB takes their expertise, takes their local market knowledge, takes all the data, everything that they're seeing, and they put together a quarterly report that they present to investors, their clientele privately on a Monday. And then we we give you the deets on a Tuesday, right? Because you're part of the family too. So we did this yesterday. We're going to update you today. Some really, really cool numbers. But Gregg, I think you like to start it off in a specific way, right?
Well, I like to start it off by just kind of taking some time to see where we are as a business, right? As a community here, and really like to start by saying thank you, right? This platform that we have now to be able to share this real estate update, honestly, to have 40, 50 of you who take time out of your day to show up because you see value. I mean, that makes me feel really great, because I know how hard it was to get one person to show up who believed that there was enough value for us to be able to share this information 16 years ago. January 6th, 2022 was our 16th year anniversary of being in business here at JWB. And I just want you to know that it's never lost on me, each and every one of you who take time to be here. It's an incredible showing of love and support, and I appreciate you more than you all know. So from the beginning to the end here, what I have known about this business and our ability to work with clients and this show, and what keeps people coming back is trust, right? Transparency, trust. That's why we put these real estate market updates together. There are some stats that I have here that I'm just super proud. I think it is a team win. These are some stats that I want to share with you. Team meaning our entire community here. And so I'm going to share them with you, just brag a little bit on my team, if that's okay with you guys, and brag on our community here. We now
brag away, Gregg.
I'm a braggadocious type of mood right now. We're just going to be bragging and bragging and bragging.
Gregarious and braggadocious.
There we go. 1,300 turnkey clients. We have over 1,300 individuals that invest in real estate here in Jacksonville, many of whom live very far away from Jacksonville and from the state of Florida. We have over 200 private lenders. Those are individuals who lend money to JWB as a real estate developer. And that's how we build 600 houses a year and do all of these renovations. We have clients in 49 states and 13 countries. There is one state that we do not have a turnkey rental client in yet. Pablo, what state is that?
The state, beautiful Mountain Mama, West Virginia.
You know it.
I know it.
John Denver special right there.
I love me some John Denver, man. Sunshine under shoulders and all.
So we have one state. This is an ask. If you know of anybody in your network who you think would be a wonderful client for JWB, I am putting it out there that will close the loop of all 50 states for us to have a client there. Please, we would love a referral there.
Peter James, just go a little west and talk to some people. That's all we're saying.
Just,
just got to leave the Commonwealth.
That's tough.
It's
the esteemed Commonwealth. So, well, thank you all. Thank you all. We're kind of cutting up here, but thank you all for your love and support here. Some numbers here that I think are just going to blow your minds. We've delivered over $41,319,000 in positive cash flow since 2011. $41,319,000 in positive cash flow since 2011.
If I was confident in my ability to whistle in front of a mic and make it not sound terrible,
I think you should try. Okay, good.
Impressive.
We have successfully borrowed over $300 million in private lending funds. We have a 100% success rate of paying those individuals back. This is during the last 10 years where, listen, there have been a lot of changes in the stock market. There have been a lot of ups and downs in other investment classes. So to have this level of consistency, what this does is it helps people have some peace of mind when it comes to their investments, which helps them live their lives a little bit easier and sometimes a lot easier for some of our clients. So I'm just really excited for all of us collectively to be able to perform at this level. We now manage over 4,400 rental properties. That means that we manage over $750 million worth of real estate. And when I say that number out loud, it even surprises me, right? Again, starting in the very beginning, I remember the very first client who placed their trust in us to buy a property. They didn't see that property. They didn't buy it the normal way. They invested with us because of the opportunity and because of the numbers and because of the trust in the team. So to think about that responsibility of managing over $750 million in real estate really matters to me. That's what I think about when I'm preparing these market updates for you. You know, our commitment to each and every one of you who are clients of JWB is that we are going to be good stewards of your money. We're going to treat your money as if it was our own. It all starts and it ends with trust. So I appreciate all of your trust. And with that, you know, we've got a fantastic amount of good stuff to get into today. So we're going to try to pack this thing with as much value and leave you guys with a lot of really actionable steps, I think, that will help you in your financial journey.
That's right. I've had a little sneak preview of these statistics. It's impressive. So what we're going to do today is a little bit different than usual, right? This is absolutely a community-led show, and we want your participation. Gregg, what happened yesterday was we were on the mic for like an hour and a half straight. I didn't eat anything. I got a little lightheaded. It got weird. So in order to get through it today, Gregg's going to get through the whole report. Put your questions in as you have them that we can ask later, because we're going to answer questions as you get them. And when he's done with the full report, then we're going to go into just like full Q&A the whole time until I pass out again. How about that?
I think that's great.
Why do you think that's great?
I mean, people should see you when you don't eat as well. They just see Pablo at his best. We should also have Pablo. We should starve you for a little while and see how you do.
I disagree. I also want to give a shout out to the Duchess, Karen, Malene, and Ed, who have made it back to their home in Baguio, Philippines. They were with us for a while in California. Right. We're going to miss them. Maybe they can tune in at midnight over there.
Wow.
But yeah, first family though.
So thankful to have the Malene family here. Just an incredible family that serves a much higher calling and a higher mission. And we love being a part of that, you guys.
All right, let's go.
And with that.
All right. Tell us what's going on with the Jacksonville market, GC. Why don't we start with the company update?
Okay, let's do that. So obviously real estate here over the last year to 2 years has been just the darling of the investment world. Single family rental properties has been an asset class that people have rushed to. And so one of the coolest things is that JWB is not just a buyer, not just a renter, not just a seller, not just a construction company of real estate. We run the entire gamut, right? We are a vertically integrated company. So these market stats that I get to share with you show you what a major player like JWB is analyzing in the market, far beyond what I tell you about what I think the market's going to do. I'm going to show you what we're doing with our own money, with our own capital, where these trends are going. So I think it will reinforce a lot of course, the same things that we've been talking about over the year. So we're going to start with just a company update. Pablo, let me know when we're sharing the screen here. We're not sharing it yet, are we?
Not yet. We're about to. Go ahead.
Awesome. All right. So you're looking here from 2019 to 2021, properties purchased, new construction starts, renovations completed, and turnkey property sales. And as we know, the last 2 years have been unprecedented. So it's really nice to look at a full 2 years, not just year over year, because 2020 was weird for everybody. But you're starting to see some trends really emerge. This first one here, properties purchased. In 2019, we purchased 592 properties here at JWB. In 2020, it was 587. In 2021, 922 properties purchased. Pablo, why do you think that this number is almost doubling over 2 years here?
Because you all are putting your money where your mouth is. You think that it is the time to double down and buy as many properties as you can, and you're scooping them up at the rate that you could possibly get them.
We think prices right now are the lowest they are ever going to be. That's why we are almost doubling the amount of properties we're purchasing. Like 600 properties in a year is no small feat.
Yeah.
Right? But to go from 600 to almost 1,000 in a 2 year span or in a 1 year span, hopefully what that reinforces is the same thing that I'm teaching and telling all of you right now, that if you are considering investing in rental properties, now is the best time. And, of course, there are other big players out there that are following that same mentality and, dumping billions of dollars into this space. So you have to look beyond the headlines, beyond the emotions of seeing that prices have risen a lot lately, and see the value that this asset class is providing now and what the market signals are telling you about what that pricing is going to be in the future, what interest rates are going to be in the future.
All right. Tell us some more.
Next up, we've got new construction starts. This is an interesting one, right? We're going to talk a lot about why new construction starts are a huge opportunity, right? Finishing new construction properties are a huge opportunity. Anybody who has inventory right now is in the driver's seat, right? So JWB, of course, has seen the signals here, and we have put a lot of resources into starting and hopefully completing new construction starts. However, in 2019, we started 431 properties. In 2021, 2 years later, we're still at 409. So it hasn't been this huge increase. So new construction starts have not jumped at the level that JWB anticipated. This isn't because we haven't put the time, energy, resources, planning to do this, right? We've seen this opportunity for us to start and finish more new construction. It's a result of the macro factors that are slowing down construction across the industry. The simple job of getting your building permit approved is a lot slower now because building departments couldn't keep up with the amount of building permits that were being put forth. Everything from that point forward is also slow because anything in the supply chain right now, you name the industry, definitely in construction, has serious limitations to it, and it's causing slower starts. It's causing slower finishes. Everything is slow. We are hoping to finish more and more new construction projects, doing everything we can, but there's a lot of macro factors that are holding us up from what we would like. And we're not the only ones, right? Builders across the industry are feeling this as well.
What I'm hearing is reduced supply, if we're talking economics, right?
Yeah, reduced supply of labor, materials, building department bandwidth, right? Reduced supply across the board.
Okay. Talk to us about renos.
Renos completed going down, right? So in 2019, we had 160 renovations that were completed. In 2021, that number is now 61. So it dropped from 160 to 61 completed in 2021. That's a pretty big drop. On the show last time, I actually started to explain this and you got mad at me for jumping in and explaining that one. Would you like to take this one, Pablo?
No, I'm good.
Okay. All right. I see what you're doing. You're taking your ball and going home. I got it.
Yeah, man, it's hard to find a property out there, right? Like there's all these big players in there used to be only one big player in the Jacksonville market. It was JWB. Now there's a bunch of big players in the Jacksonville market and they're playing, they're out there scooping up just
what you're saying. Players be playing?
Players got to play.
Okay. Players got to play. Write that down. So yeah. So in addition to the overall theme here that players got to play, there's this is existing inventory, which is just nowhere to be found, right? If we could have the number of renovations that we could purchase and complete, and if that number was 200, if the market was offering that, we would have this be 200. It's just simply existing inventory is not there, which is why there's such a focus on new construction in order to meet the demand that is coming to this marketplace. And lastly, turnkey property sales, a collective win across the board. We went up from 397 new turnkey property sales in 2019, finished out 2021 with 531 property sales. There's 531 properties that were purchased by clients last year at the very best time, in my opinion, to do that when interest rates are so low, when prices are lower last year than they are this year. So I'm really, really excited for everybody who took advantage of that. And really excited for our team internally here as well. Obviously additional sales is a great thing for our company. It allows us to further insulate and prepare and protect our team and our clients and prepare for rainy days in the future, which undoubtedly come. And so just excited about, that statement right there. This asset class works. The clients that are purchasing properties from JWB are performing very well. They're coming back and purchasing more. And that's the greatest testament to a job well done.
I agree. I mean, you look at all this stuff and you're seeing, I from everything you shared, I hear congruency, right? Like I hear the idea that you continue to beat the drum, that there's never been a better time to buy. And it's, right now you just kind of said that there was a best time to buy, but it's still the best time to buy based on like what's going to happen in the future right now. So you guys are buying up as much as possible. You're saying that what's driving that is a dearth in supply, right? Which you can see by the inability to build too many new constructions and the inability to find a lot to remodel, right? Like that's getting hard. And then of course, reduce supply, increases demand, increases transactions. You're selling turnkey properties like it's hotcakes.
There you go.
All right, man.
Love it.
All right, cool. So let's talk about the KPIs.
Yeah, now we're going to jump a little bit more into the property management component. And now that we understand how JWB has fared and you're seeing how market trends are kind of working within the walls here. Now let's go to you, right? And your performance of your properties, your portfolio hinges on the performance of JWB property management. And so let's take a look at those KPIs here. We've got, let's see, which one are we looking at there? Boom. All right, cool. So rent collection numbers. In 2019, we collected 98.5% of rents. That is prior to COVID. 98.5% is our historical average. And so that was a normal year, but for any property management company that collects 98.5%, that is like bonkers off the chart good. So huge shout out to our property management team for making the impossible seem just normal. 2020, in a year where there was an eviction moratorium, while there were many challenges that we faced as a nation and as renters and as a property management company, our team, JWB, collected 98% of rents. So proud of our team for doing that. And then in 2021, we were at 98% as well, right? For a lot of 2021, we still had to deal with some of those things like an eviction moratorium. We are still working with programs that are designed to help renters who have experienced hardships. So things are still different. Things were different in 2021. However, we are seeing a lot of those challenges, work themselves through as the effects of COVID are less today than they were in the past. And also as things just become more normal and normal course of business. So 98% for last year and looking forward to another great year of rent collection in 2022. Moving on to average rent per property, just some really good data to show you all. I mean, we see a lot about how rents are going up year over year in Jacksonville and in other markets. Internally here, our average rent per property was $1,105 in 2019, and that has blossomed up to $1,275 2 years later. Significant rent growth and means better cash flows for all of you, better return on investments for all of you. And you all are being handsomely rewarded for a lot of the macro dynamics that are affecting real estate. And there's a reason why so much money is rushing to this asset class. Yeah, I'm trying to do the math. That's like a 15% increase over 2 years. Yeah. I think I did. Yeah. Because it's 13 from 2020 to 2021, the math before. So you can clearly see the huge jump from last year to this year, which is congruent with what we've been reporting on nationwide. All right. Current properties under management. This is a big focus for JWB. So for those who aren't aware, in addition to selling properties and doing the management for clients who purchase those homes from us, we also do manage homes for those who don't purchase homes from us. This is a core part of our strategy, is to grow our properties under management because it further insulates our business, protects our team through any market cycle that we may see in the future. And so we are continuing to grow. 2019, we ended with 3,334 properties under management. That number jumped up to 3,790 by the end of 2020 and continues on that very positive trend to 4,306 properties at the end of 2021. Great statement on the growth and the health of JWB and also your trust for us to manage your assets for you. And it's going to continue to grow rapidly. I mean, this is a key growth opportunity for JWB this year and in future years. Let's talk about that, GC. So, we're talking about this growth in properties. It's not just, these aren't just properties that you're building and you're coming to market. You guys have like 3 different ways that you increase your properties under management, if I'm not mistaken, right? You're the ones that you're bringing to market. You have ones where there's an investor that has a property somewhere in Jacksonville and they decide that they don't feel like being a professional property manager because that life is not for them, right? And they bring it to you. And then there is the property management company that figures they might just cash out and go take that money and invest it somewhere else in a time where it's getting good and wants to hand it over to somebody who's going to treat them real well. This is part of the beauty of our business model here. If you're a typical property management company, you're not putting an additional 400 properties a year into your portfolio or 500 or 600 properties a year into your portfolio. There's no other property management company around who just does third-party property management that I know of that can post those types of numbers, right? That is really hard to bring on that many clients and have that many new potential leads coming to you. It just doesn't happen in the property management world. And so we have this amazing opportunity because we believe so much in the asset. We buy the asset ourselves. And then we, of course, have clients that purchase those homes from us that want us to do the management. This is like a closed loop for JWB. And that's part of why we love this business. It's part of why we started this property management company. It's because, your sources of income as a real estate developer can be very far and wide ranging. Many developers out there make a lot of money, but it comes in big hits. And then they have to prepare for down years when something doesn't work out and they don't have that steady stream of income coming in. For JWB, one of the big values of property management for us is that it's that steady stream of income. It's coming in. And so it allows us to be opportunistic in other things, right? It allows us to have an innovation department where we take risks with our own money to see what is working so that we can eventually roll out to other clients That's really in a nutshell what property management does for us from a numbers perspective, from a business health perspective. And we do that through those three things, right? We buy the land, we build the houses, or we renovate them. Those eventually turn into properties under management because they're sold to clients who then hire us as the property manager. And we also take on outside clients who hire us strictly for the property management services. You know, about 25% of our portfolio actually comes from those property management clients who hire us for those services.
And those don't have to be in your core neighborhoods. That is just Northeast Florida, Duval County.
Yeah, there's a set of standards that we have to make sure that this is going to be a good fit for that person, but it is not location specific in Jacksonville. So we almost without exception, we will take a look and we will consider it based on location in Jacksonville. It's more about a fit for that owner. We don't want to manage. We don't want to work with somebody who would view themselves as a slumlord, right? We're not going to be associated with that. So there's a standard that we have to excuse me, have to hit there. But yeah, so that's the second one. And the third one is the buying of property management companies. And we've made 4 company acquisitions over the past 2.5 years. And so for the right opportunity to buy that book of business, we are excited about doing that, but we're very picky, right? We have no reason to chase a book of business at this point with the type of scale that we have.
Got it. So, we just bring that up because opportunity to refer somebody to JWB, right? If you know somebody that's got properties under management in Jacksonville, they want to cash out, bring them over to JWB, right? Or they're doing it themselves and they just want to live their own life.
Yeah.
Bring it over to JWB, right?
Well, yeah. And it doesn't even have to be a cash out type of a thing, right? If they would like to have it better managed than what they're currently receiving, that's an opportunity for them to bring the management over to us. Of course, if they would like to sell the house, then we are always buying.
I meant cash out the business.
Oh,
So
cash out the business.
if you have a business, you want to cash out.
Gotcha. Phew.
Right
over my head.
For owners. Yeah. Lee, this is a good question by Lee. Is the 4 management companies that you brought under the umbrella, was that just the houses acquisition or was the team brought on and taught the JWB way?
Great question. It was just the houses. It was just the contracts, the property management contracts, and then of course, taking care of those residents. We did not bring teammates internally from other companies. It just didn't seem to work. Not that we would be opposed to doing that, but it didn't work out that way.
And Nadim's asking, is the management fee the same for outside customer joining JWB and regular JWB clients?
Well, when you buy a book of business, in order to buy that book of business, you need to honor the terms of that other property management company. So I'll tell you, we analyze the terms of a property management company coming in before we would buy that book of business. And more often than not, those terms are very similar. Not always the same. Sometimes the management fee might be slightly different, less. Sometimes it's higher. Sometimes the tenant placement fee might be higher or lower. So at the end of the day, largely it's the same cost for the services, but it's important for us to honor those pre-existing contracts.
Cool. All right, man, let's keep it rolling. Let's talk about more property management KPIs.
Love it. So we'll kind of fly through this one. This is just more of overall health of the business, something I'll keep reporting on for you all on a quarterly basis. But look at some of the rent growth, or look at some of the growth of some of these numbers that have to do with renting houses. Total rented houses in 2019 was 982 properties, an incredibly high number. If you want to know why JWB probably is a better resource to keep your home rented, it's because we did it 982 times in 2019, times whatever we did the years before and before and before. Well, that number continues to go up. In 2020, it was 1,116 homes that we rented that year. And in 2021, it jumped again to 1,201 houses. An incredible job by our leasing team in a time of a lot of new things that were thrown at the team, the world, anybody who's looking to rent. So super proud of our leasing team.
25% increase, essentially.
Love that.
Yeah.
Love that.
All right, keep going.
Average duration of initial lease. This is the very first lease that they sign. And we focus on long-term leases, either 2 or 3-year leases. So you can see that number continuing to remain strong. Over 26 months has been the norm now since 2019. We were at 26.9 months. In 2021, we're at 26.2 months. We're seeing continued growth. Many times, for many years, people said you'll never be able to rent long-term properties. You'll never be able to get people to sign 2-year leases, 3-year leases. Your number of homes will decrease so much that you're able to rent out when you require this. And when you match those 2 numbers up together, you just see that's just simply not the case.
Yep. Averaging above 2 years on the initial lease.
And if you take all of the lease renewals and how long a resident actually stays, it's much higher than that. It's actually 54 months is our duration of resident stay in total. And that's what is linked to your success. The longer that long-term resident stays, the lower your maintenance costs, the lower your vacancy costs, and the lower your property management fees. And so that's how you win.
54 months is 4.5 years.
Yeah.
I did the math all by myself.
There you
Continue.
go. Number of leases re-signed. Look at this. Look at this growth. 569 leases re-signed in 2019. That makes that number look somewhat small, but that number is incredibly large. 569 people signed a 2 or 3 year lease originally, then said, yeah, I'm going to re-sign another lease for either 1, 2, or 3 years. And they know that their rents are now being brought up to market rent. Market rent in 2021 is a lot higher than what it was in 2019. But look what we did coming into 2021. 1,137 leases renewed during the year of 2021. Thank you, brother. Thank you. Gosh, I love those sound effects. It just makes it. I mean, that is just such an incredible time. It is harder to re-sign leases in an environment like this when there's less things have been normal for folks. People have had a harder time making decisions on where they are going to live. Are they going to live for 2 or 3 years when things have been less stable because of the COVID world? And then the reality is that rents are going up substantially. People are not re-signing these leases for lower than market rent. I wanted to make sure that people know that. That is a way that many property management companies keep people in homes. That's not what we're talking about here.
GC, I think about everything that we talk about of the success of this asset class. And you talk about how you buy the property once, but you're property managing it for the life of it, right? And that's what really matters. And you always talk about the importance of this re-sign and keeping your resident in. Would you say that, I know that everything matters, but would you say that this is the number one KPI of a successful investment, is how, how often you re-sign people or length of stay?
It is up there, and it is probably matching most important and most neglected. That's probably what the stat is, right? People just simply don't know what their re-sign percentages are in the property management world. They don't know what their average duration of resident stay is. But if there is not a better correlation to, are you successful as a rental property owner in terms of limiting maintenance and vacancy costs, then re-signs, resident stay, staying very, very long and continuing to get longer. And nobody asked that question. So yeah, I'm with you. It's very important.
Okay. All right, man. Keep on.
Eviction percentage. Again, any of us want to incur an eviction, but if you're like me and you own properties for a very long time, it's going to happen. We manage 4,400 homes. So we get a very holistic view of what that percentage is. And in 2019, historically, we average about 0.39%. So that was a relatively normal year prior to COVID. COVID happened in 2020. Our eviction percentage went down to 0.18%. That's not because we got that much better. It's because there were eviction moratoriums and you couldn't evict. And some of that was there in 2021. However, that stopped at some point in 2021, and we were able to go forward with all of those evictions that were sort of pent up there. So in 2021, we came in at 0.36% for an eviction percentage. And we think that's largely where we're going to play. That's kind of normal for us. And we think that's very representative of that, any after effects of that eviction moratorium going away as well.
Seems low, man. Michael Santorios wants to ask a question here. Gregg, not to open up an ugly part of the investing, this asset, but can you address the eviction process? I know JWB does a lot to bring renters current, but what's the process?
There is so much that goes on before you throw in the towel and actually go for an eviction. And if there's one thing that we do or a successful property management company does for you that other property management companies don't do, is many just throw in the towel. So from the time that somebody doesn't pay their rent, right, we are always trying to communicate with them. There's a tool that we use called a stipulation agreement. Most property management companies don't do this because it's extra work and they don't make any money when they do it. They actually make more money if they evict your resident because they get to put a new resident in there and charge a tenant placement fee. However, a stipulation agreement is a lot more work. What we do is, if a resident can't pay for whatever reason, we want to communicate with them. If a resident refuses to communicate with us, then we have no choice but to go forward with the eviction. If the resident communicates with us and we understand where their finances are and what's going on in their life, and we see that there is an opportunity for them to make the payment, then we're going to put them on a payment plan. That's what a stipulation agreement is, except it's court designated by the courts. So what happens is you start the eviction process, your property management company works with that resident And when we reach an agreement, if we reach an agreement on that stipulation agreement, that payment plan, then what the court does is it says, okay, I'm going to stop the eviction right now. This is your last chance, Mr. or Mrs. Resident. If you comply with the agreement that you have made with the owner of the property manager, then we will halt the eviction. And so this is a wake-up call for a lot of residents. And we have over 50% of stipulation agreements that end up being paid back in full with keeping that resident in your home, which blew my mind when we started to roll this out, that we would be able to save 50% of potential evictions out there. I should also point out that any of the costs that go in with an eviction are also the responsibility of the resident to pay off during the stipulation agreement. So at the end of the day, assuming that this can happen, which happens more often than not, your resident is able to stay in your home and you are made completely whole with any lost rent plus any fees that you may have had to front for the eviction. And it's a wonderful way to keep a resident in your home long-term, and something that many property management companies don't do.
Beautiful, man. And listen, I am a benefiter of this program, right? Like 2021, we had our residents that were there. They went through some hardship. JWB, put a bunch of different things in place, helped them find a different charity. At the end of the day, instead of having lost that rental income that I would have lost had evicted him, had I evicted him, I ended up getting paid back in full.
That's
plus
really cool.
a penalty. It was, it ended up being a very positive cash flow situation, but it was a win-win, right? They got to stay in their home.
That's what we want.
Doing it right. Yeah.
Some people fall on hard times, but there's no excuse for no communication, right? That's the one thing we can't help with. If there's communication and there's an opportunity to pay it back, right? We're going to work with that resident and make the owner whole.
Yeah. We were just talking today about my man crush on your communication style today. All right, Greg, tell us about the Jacksonville market pricing data.
All right. So the market is, of course, on fire. And this is just a really fun time to talk about what the market is doing, partly because we have been talking about why this is happening for, over a year now. And the concepts that we have been reinforcing, lack of supply, increased demand, they're just happening. It's just happening. And that's why now, as we look forward to next year, those same market signals are even stronger. And that's why I've never been more confident as we look into next year that home pricing is going to go up. But before we get there, let's take a look at what happened over the last 2 years. In January of 2020, our median home sales price in the Jacksonville market was $230,000. In January 2021, it jumped up to $256,000, which was a large increase. That was an 11% year-over-year home price appreciation increase. As we look to January of 2022, that number for median home price jumped at a level that we have never seen before as long as we've been tracking this in Jacksonville. It jumped up 24% to a median home sales price of $318,000. Gosh, there's never been a more justified whistle than right there. Your days on market is going down because there's not enough supply and people are buying properties as quickly as they can. You can see those appreciation numbers year over year. As I mentioned, the highest we've ever seen. The average historical home price appreciation in Jacksonville since 1982 is 4.6% per year. So when you see 8%, 11%, 24%, which is what you've seen over the last 3 years, there are significant macro factors that are working in your favor right here if you're an owner of rental properties.
Let's talk about those macro factors, right? There is a giant macro factor that was happening well before anything happened, where Jacksonville is one of the top 10 growing metropolitan areas in the United States for
Absolutely.
a while. Then
number 5, actually.
Number 5, right? But like in 2020, it was number 5.
From 2017 to 2019, according to the U.S. Census, we were the 5th fastest growing MSA.
There you go. There you go. And then COVID happens. A market that was clearly underpriced before, that is now available to people that have been detached from the geographical attachment to their job. People are looking around. They're like, this is a great deal, great place to live. I'm going to start coming in here, right? So whatever was happening before, now it got greatly accelerated by the demand for Jacksonville housing has been, it used to be capped by socioeconomic factors that were confined to the economy of Jacksonville, which was doing well. But of course, it can only grow so fast. Now, all of a sudden, the rest of the United States, Europe, South America, wherever you're at, you're able to move here
Mhm.
and work in your job in the investment bank back in New York, work in your job in the tech company in California, and live here at much less cost with a
Mhm.
really, really high quality of life. So
Yep. You're talking about from the demand side. That's real, right? This was already a lot of demand coming in from migration to Jacksonville
Yep.
because of those factors.
Yep.
Now demand skyrocketed because of the COVID change, and it probably pulled some demand forward as
Mhm.
well, right? Some demand that was probably going to happen in the future. That's what low interest rates tend to do. It pulls some of that forward. So your demand went way up. And now, as we'll start to look at some of this data, the easiest way to show demand going up
Mhm.
is the number of home sales going up.
you said something key there, right? Like I brought up the macro kind of like demand for housing of people that were moving here already because it's a growing population, sped up by COVID. And then the urgency of interest rates are going to go up. So people decided to like move quickly
Mhm.
and buy something right now.
Mhm. If you were thinking about buying a house in the next year, you saw interest rates in the threes, are like, oh, all right, I'm going to do it now, right? So it pulled some of that demand forward as well, and sales have gone up tremendously.
Got it.
Right, number of sales per month. We had never had more than 3,000 sales in any month in Jacksonville's history, and we started to have that in, I believe, in June of 2020, and it was just month after month after month of 3,000 sales or more.
Nana Mustatinde, tuning in from France, asks, do you think that this price appreciation is sustainable in the next 1, 3, 5 years from now, irrespective of interest rates? And, Anonymous, we are going to basically answer that in the next couple slides, right?
Yeah, I love that. It's
All
a great teaser right there.
Let's talk about it.
All right, so we've talked a little bit about the demand side of what Pablo has been talking about and what I've been helping with there, right? Well, the easiest thing for us to see is look at that total sales number right there. In January of 2020, we had 1,934 sales in the month of January. Now, you heard me just mention 3,000 sales in June, right? You generally have a lot more sales happening in the summer months than you have in January. So what you're trying to look at is for year-over-year growth in the total number of sales, which is what we're saying here. So, but January 2020, we had 1,934 sales. In January of 2022, that same time of year, we had 2,304 sales. So you're seeing increased demand, right? The bigger topic is inventory level. So now we were just talking about demand side, which is absolutely a factor, but look at inventory level. Look at the supply of housing. For years now, there has not been enough supply to meet demand. And the greatest indicator of that is something called months of inventory, which we'll touch on in just a second. But just look at the inventory numbers. In January of 2020, we had 7,885 homes on the market in Jacksonville. By January of 2022, 1 month ago, roughly, we had 2,949 homes on the market. We only had 2,900 homes on the market and we have 2,300 sales. The way you track months of inventory is you see how many homes are on the market, you divide it by the number of sales, and that tells you how long it takes to exhaust a market. A normal functioning market has between 6 to 7 months of inventory, right? 6 months of inventory at 2,300 sales is like 13,000 houses or 14,000 houses. We have 2,900 right now. So we are at 1.28 months of inventory right now. 2 years ago, we were at 4 months of inventory, and that was low. I'm going to show you a chart here in just a second, just to show how this is just falling off a cliff. Months of inventory falling off a cliff and going low is an indication of higher than normal home prices in the short run. And that's what we're looking at right here.
Well, not really looking at it. I was just going to hit the point of that January 2020 stat of 4.0, months of inventory was what happened when COVID hit. Everybody was freaking out about the fact that pricing is going to drop. Should I sell my house? Should I get out of this investment class? And you came strong saying that you were sure that pricing was not going to drop because you quoted the idea that equilibrium months of inventory for Jacksonville is about 6 to 7. Right now we're at 4. That means that in short-term pricing, it's not going to drop. And not only have prices not dropped, but months of inventory have drastically dropped. And that's made that ridiculous appreciation that we've been seeing. Exactly. All right, let's talk about this graph.
Yeah, well, now let's just show what that really looks like. Yeah. This is a graph of the months of inventory data from the Jacksonville market going all the way back to 2017. That top line is the equilibrium inventory. You see between 6 to 7 months of inventory, exactly. And that bottom line is the actual months of inventory. The blue line down there is actual months of inventory. It's largely between 3 and 4 for many years, which is way low. And then look what it's done. It's gone so low that the chart that we created did not hold enough. It was below 1 month of inventory for a while there.
They broke the chart.
We broke the chart. It's so low. So as we're talking about Anonymous 10 days question, love that question. In the short run here, over the next year, I've never been more confident that home prices are going to go up. And I'll show you what some of the experts across the investing world are saying as far as what their predictions are. But the reality is that there are just not enough homes in supply right now. There still is high demand, right? No matter if demand softens a little bit, there's still such low supply that it's not going to matter. Home prices are going to go up because they have to. When you don't have a lot of stuff and a lot of people want it, your home prices go up. And that's really what we have. Now, beyond that, over the next few years, right? 3 years, 5 years, I'm gonna refrain from giving some market predictions for 3 to 5 years, because 5 years ago, I never would have predicted that we had COVID and that we'd have seen prices jump 20%. So we're going to continue to I need you to tune in every single week to keep checking on me on that. But what I'll tell you is that in the short run, home prices are going to go up. I'm really confident that home prices are not going to be lower in the future than what they are right now. If home prices go up another 20 or 30% right now, you're going to start to have affordability issues. You may have a correction at some point in the future. I mean, no, it's not going to be sustainable for it to go up at this rate, right? If it goes up 5% or 10% or 12% this year, are you going to have a correction? Probably not, right? If it goes up 20 or 30%, at some point, things are going to correct themselves as well. So no, I don't think it's sustainable. I don't think it's healthy for anybody for home prices to continue to go up 20 to 30%. But the bigger thing is that no matter what happens 1 year, 2 years, 3 years, 5 years from now, right now is the lowest home prices are going to be in Jacksonville, in my opinion.
Coming strong with it. So Anonymous, the answer to your question of are prices going to continue to rise is oui. And you don't have to take Gregg's word for it. You can take the other big players in the market.
There you go. There's a few headlines that I just pulled. These are recent. And Fortune, I had an analyst that said he was going to see a 12% increase in home prices this year across the country. Goldman Sachs says 16%. Zillow says 11% home value growth in 2022. And, we think that we're going to be similar.
There you go. All right, GC. So what's next? This is your favorite graph that you love talking about.
Oh, yeah. So let me play devil's advocate here, right? So I love this graph. I want you all to see this graph. I want you to know it, love it, like I love it, right? This is a graph of what historical home pricing data has been in Jacksonville since 2001. You can learn so much here. You learn how that median home sales price number is that red line, that smooth line. That's going up at that rate of 4.6% per year. And that's what the market value of the market should be according to historical averages. Now, does it ever actually move like that? No, it tends to go up a little bit and usually it reverts back to the norm, back to the average, and then it goes up a little bit and reverts back to the average. Maybe it dips a little bit and goes back up, but typically you don't see this huge crash. But we saw that from 2006, 2007 to 2011, we saw the great dip there. What you'll see here is that if you invested for a full market cycle, things came back to the norm. That is such a crucial part of our investing strategy. You buy and hold for 10 or 20 years. And if you do that, I pretty much know what your home price appreciation rate is going to be after that 20-year period. It's going to be somewhere around 4.5%, most likely. I can take any period of time across any market. And if you give me a 10, 15, 20-year cycle, I can guess their appreciation within 1%. That's how appreciation works. So look, our pricing right now is over that median projected home sales price line. So we're over that. So what that means is over time, I would expect this to come back to the norm. That doesn't mean prices fall. It just means that they grow at less than 4.6% to hit that line. So I think over time that will happen. But this does not mean every time you go above the line that you're going to see prices go down, right? I'm saying that home prices are still going to go up this year at a fast rate, higher than normal, higher than 4.6%. Other people know this information as well. And Zillow is coming out and saying 11%. Goldman Sachs is saying 16%. It's because this is one factor to look at, but the overriding factor across all of this, more important than interest rates, more important than maybe a softening in demand, is lack of supply. And it is going to take longer than a year for home builders to build enough inventory to solve the problem.
There you go. All right. So you kind of teased this whole idea of being able to know the answers to the test.
Yeah. For all of you who say, listen, I love this asset class, but I don't want to be that guy or that girl that invests at the wrong time. I don't want to buy at the height of the market. What happens if the market goes down? Guess what? I was that guy that bought at the exact wrong time. I started to invest in 2006, bought about 40 rental properties. I was 23 years old at that time with my business partners, and we were leveraged very highly. Now, I knew how to invest, and I knew how to invest in positive cash flow, so that mitigated the risk. But at the end of the day, I saw my market values drop 35% over the next 4 years. So I know what that feeling looks like. I also know what it feels like to hold on for a full market cycle, since I've owned these properties for 16 years. And I think it's really telling to put some of these numbers together, because when you look at what has happened over the last 10, 15, 20 years, I think it gives you great peace of mind to know that, listen, maybe I'm wrong. Maybe home values crash tomorrow. If you hold on for long enough in rental properties, you generally win. So let me show you what this means. If you invested 10 years ago in the Jacksonville market, your median home sales price in the market was $120,000 in January of 2012. The median home sales price right now is $318,000. That is average home price appreciation year over year of 10.2%, over double the historical average. It was really nice to invest 10 years ago.
Very nice.
All right. Let's say you were like me, though, and 15 years ago, you invested the wrong time to invest, according to most people. And subsequently, you saw your market values drop. Well, you would have invested at $190,000 as a median home sales price. It's still worth $318,000 now. So at the worst possible time, you still would have seen average appreciation of 3.5% year over year over year, right? Is that bad?
No, that's pretty good.
Yeah.
I mean, especially if I know that we are talking about appreciation, right? And when you are selling me a rental property, you are selling me the cash flow and ROI contained within the confinement of the property lands, right? So these like 7 to 9% returns that we're looking at have nothing to do with this. And I also know, because we do the POTW all the time, property of the week, and I know that 3.5% appreciation when I am financing it at 25% is really 13.5% appreciation.
Exactly.
And if I'm financing it at 20%, it's like 17.5% appreciation, right? So like,
Exactly.
I know that the appreciation is a little bit of a bonus. So if it keeps being positive, you're still making out well as long as the cash flow is positive.
Exactly. And we're talking about worst case scenario. If you perfectly time the wrong time to invest,
yeah,
this is how this would have worked.
Yeah. Legendary timing.
Legendary, terrible timing. If that's you, you're still going to be okay.
You can still grow up to be Gregg Cohen.
All right. What do we got next?
We're talking interest rates, man.
Interest rates. All right. Interest rates. I've been beating that drum for a long time. Interest rates are going up, but let's talk about why this is so important for you to pay attention to what's going on right now. It's because a 1% increase in interest rates for a JWB property and for other properties that you may potentially invest in, a 1% interest rate hike equates to a 38% decrease in your return on investment from those cash flows. If that same property you buy today and it has a 4.5% interest rate on your loan, you buy that same property a year from now and it has a 5.5% interest rate, your return on investment from the cash flows drops by 38%.
That's steep, man.
Yeah. So I put a little case study together here. We won't have enough time to go through it in full, but if you want to talk more about that, jump on the phone with my team. Reach out to Madison here. We could set up a phone call, because this is why timing is important. When it comes to interest rates, timing is important. When it comes to home prices, in my opinion, it's less important, because after 20 years, it's going to be largely around 4.5% year over year.
Got it. So go quickly through this, man.
Yeah. So this is a current property. It's actually a property that is available. This is actually a little teaser here for those who are showing up on the property of the week on Thursday. We're going to be talking about this one on Plum Street.
Plum Street.
Yeah. So that same property at 4.5% interest rate has an estimated return on investment of 7.17%, not including home price appreciation. We go to the next slide at a 5.5% interest rate. That total estimated conventional financing total return on investment drops to 4.45%.
Same house, same price, same address, everything like that. 1% different, major change in the return inside the property.
If I came to you guys and I was like, hey, this is a change that we're going to implement at JWB. Our fees are going to go up and it's going to drop your return 38%. You'd be like, what? What? You're doing that? What?
Yeah.
I'm telling you, this is not a fee going up for JWB, but your cost of this investment is going to go up and it's going to result in 38% lower return on investment. Like that's why this is urgent for you to take advantage of low interest rates.
Got it. All right, let's keep talking interest rates now.
So they've already started to go up. Many of us are aware of this. I'm just showing you that this is already starting to happen. So in September of 2021, the graph I'm showing you here is the 30-year fixed rate mortgages across the entire US. So think less about how this compares to what your rate is going to be on your property at JWB, because you're not comparing investment properties in Florida, right? Primary residences have a lower interest rate and yada, yada, yada. But just look at when the lowest rate was 2.77% in September of 2021. Right now, that has jumped to 3.69% as an average mortgage rate in the US. It is already starting to happen. It is still extremely low interest rates, extremely low interest rates. So it's already happening. And then as we go to the next slide, you're going to see here that this is before the Fed has actually implemented short-term interest rate hikes. Fed hasn't actually done it yet. They said they're going to do it in March. So this is the market understanding that interest rates are going up. This is the stopping of quantitative easing, which we've talked about a lot on the show. And from this point, you're going to start to see 3 interest rate hikes, according to the Fed in 2022. And so that is going to put further pressure on raising interest rates and raising your interest rate on your property that you purchase.
Got it. So to summarize right now, because we're going to go into inventory now, right? And answer Ken Moline, patriarch of the Not Your Average Investor Show community. First question there was, what is the status of JWB inventory? We're close to buying status again. Market looks like this. Low supply, high demand, prices are going up, interest rates are going up. The future of the investment class is that returns are going to be lower in the future than they are today. And for the foreseeable future, that's what's going to happen, right?
Mm-hmm.
Like prices are as low as they're ever going to be right now.
Mm-hmm.
Interest rates are as low as they're going to be for a while. And that means that returns are as high as they're going to be at this moment right now. So talk to me about inventory.
Well, and guys, I'm going to go a little bit long here. So I just want to give you guys a little bit of a heads up. I know we're at 1:30. I think this is going to be really critical for you to hang with us for the next 10 minutes or so if you have that availability. Because now what I want to do is take all of these macro factors that we're talking about here, throw in a little bit of insight into the construction industry as well, and then bring that into your experience as a JWB client. So I really appreciate the trust that you have in me for doing this. I think this is really kind of the biggest value I can bring to you is to take all of these things that I'm seeing, bring it close to you and your buying plan and your experience here, and then give you some ideas on how you can financially engineer your portfolio to make a better return on investment. So that's really what this is all about here in the inventory section. Times like this, calls like this right now in a real estate market and in a construction world that is changing as rapidly as it is right now, this is the most important thing that you can be doing if you're interested in investing in rental properties in Jacksonville right now. So I appreciate all of you being here. That being said, let's talk about you first. Let's talk about what you're experiencing, the highs and the lows. On the high side, there has never been a better time to invest in rental properties. I've been beating this drum for well over a year, almost 2 years now, when I saw all these forces starting to come into effect. And those clients that have been investing for the long haul and those who have taken us up on this over the last 2 years, you all have benefited so well. Home prices are up at a rate that we've never seen before. Rent prices are up at a rate that we have never seen before. And your interest rates have been incredibly low, which out of all 3 of those, I'm most excited about your interest rate because you now have that ability to borrow that debt, smart debt, for 30 years. And you can use this as a way to create generational wealth. So by and large, things are really, really great. It's fun to do a real estate market update like this. I don't know if I'll ever have another real estate market update where the numbers are so good in so many ways because interest rates are going to go up.
Yeah,
again.
cartoonish numbers.
Yeah. So I fully recognize that. I want us all to give ourselves virtual high fives, right? You all made this decision. Boom. You all made this decision to invest in this asset. It wasn't easy. You had to invest with a partner that you probably never met before. I never got to shake your hand, right? You never actually met my team in person. But you thought about this investment class differently. And I think you all should be applauded for that. It's not easy. And look at what you have created for yourselves, for your family. So with that being said, I'm super, super jazzed about what has happened over the past couple of years for all those who own rental properties. Also, with all this good news, it hasn't been perfect. And there are many JWB clients that have had negative experiences revolving around a couple of things. And I wanted to, in full transparency, bring that to all of you right now and talk about those things that are not great experiences for clients at the moment and what we can do about that to make it better. So the first thing I'm going to talk about that is not all rosy and that's not a great client experience is when clients put properties under contract right now to purchase a home, right? This experience for us matters so much, but it hasn't been perfect. A lot of this is due to factors that are hard for us to control. But the reality right now, if I go back 2 years ago, when people put a house under contract, it was a completed house or a completed renovation and a resident was already in that home. And that was the way that things have always been, or very similar to that for JWB. When everything that just happened that I just shared with you, that created an extreme lack of supply in JWB inventory. And so in order to be able to provide inventory for clients, we changed our approach from offering clients the opportunity to buy the property when construction was finished to we started to go backwards in that timeline, in that cycle. At one point, you could put a property under contract 8 to 9 months prior to when the home was going to be complete. Like as soon as we were going vertical on it, we were going to make it available for you to lock up, right? We now are about 4 to 6 months away. So clients put properties under contract today. We have done our best to assign a timeline in the future, 4 to 6 months in the future of when we think that's going to close, when the construction is going to close. But it's not fun. It is a hurry up and wait experience for folks. And so I wanted to let you know that I recognize that. And we're looking for ways to improve it. Some other things to consider. Because it's a hurry up and wait experience, and I don't exactly know when your timeline is going to be, timelines are getting delayed, which means that you put a house under contract, you can't actually lock your interest rate in today. And that's a challenge because you hear me talking about how I'm expecting interest rates to go up in the future. Well, I can't help you lock your interest rate right now if the house isn't built. You can't lock your interest rate until it's actually built or very close to it. So it creates a lot of strain. The client is frustrated because of elements like this. The builder has a lot that's going on and they're frustrated because we're hammering them as much as we can to get these things finished. Our internal team is working with clients that are frustrated and there's additional strain on all parties. And so the reality that kind of hit my business partners and I over the past couple of weeks has been that there is a better way to do this. And so that's what I'm going to share with you now, this better way that I think will help all involved.
I mean, when I think about what you're talking about, like it makes a lot of sense. If you're saying that a 1% rise in interest rate is going to reduce your ROI by 37%, and your number one core value is under promise, over deliver, and you're exposing clients to the idea that they're going to sign up for a property, they're going to be committed to this investment in a property, and you can't guarantee that the interest rate isn't going to be 1% up. I mean, that seems like a heavy risk for a client to endure when they're locking something up just for the psychological safety of saying, I signed up.
Yeah, well, it was a different ballgame back in the day too,
Yeah.
because interest rates were largely stagnant
Correct.
for a while.
Yeah.
So it was okay, in our opinion, to do this back in the day because interest rates weren't rising. That's changed now. We also had a much better handle on timelines for construction, right? A year ago, the supply chains were not as messed up as they are today.
Yeah.
Now it has gotten noticeably worse. In fact, I put some numbers together here. Just construction world, real estate dynamics, construction build prices for JWB, for us to build these assets for you, they are up 30 to 50% over the last 2 years. That means that house that cost us 100 grand to build 2 years ago now costs us 130 to 150 grand to build. That is okay. That is our risk. We are comfortable understanding that, but that should just be known because this is going to inform our decision going forward here. As I mentioned, construction build timelines are not pretty today, and we're expecting them to get worse through 2023. I don't expect this to change anytime soon. And then there's this thing called variable price increases. These are things that just hit builders at the very end of a build with little or no warning. Impossible for us to plan for this. And these are $2,000, $5,000, up to $20,000 price increases that we incur with no knowledge. And when you're starting 600 homes a year, that's real risk. That's real uncertainty. that is different than what we had in the past. And now most builders say, okay, I understand build costs are going up, but home prices are going up, so we'll be okay. And that does play out well, right? This is not all bad for JWB. However, the fact that things are changing so much with pricing and interest rates going in the future, and timelines are getting so far extended, makes it really difficult to price assets today that are going to be sold 6 months from now. And that's why you see builders not selling pre-construction, not selling under construction homes anymore. They're restricting their inventory, which is weird because years ago, builders loved selling pre-construction and loved selling homes that are under construction. They saw it as a badge of honor back in the day, and now they don't do it.
I mean, I remember back in the day, and this is like, I'm thinking of like the 2000s, right? Like it was, you were buying something pre-construction, but the builder knew that they were going to juice you at the end with these like price escalator clauses that were built in as well.
Yeah.
So, I mean, is that still happening right now, or are those not able to keep up even?
Well, that's a really good point. I mean, there are a couple different ways to skin the cat here, and other providers and builders do use escalation clauses. So that is one way. You can put somebody under contract as a seller and have that buyer under contract, and in the clause in the contract, it might go up 2% a month, right? The home price might go up 2% a month. But if we're doing this to improve the client experience, we see that as a big risk to the client experience, right? And you're still pricing this. You don't know what home price appreciation is going to be over the next year. Could be 20%, could be 10%. So somebody's losing there when you price it with that escalation clause as well. And so it's just really tough. It has flipped this industry as far as how they sell and price assets on its head. The things that they used to have pride in, now they say, I'm not playing that game because there's too much risk and uncertainty.
Wow. Okay.
Yeah. So we think there's a better way. And that better way is that we are going to allow clients only to put properties under contract when the homes are actually completed or within 45 days of completion. Right. So whereas we used to allow clients to put homes under contract that were in the construction phase, many times early on in the construction phase, we are no longer going to do that because we don't think it's a good thing for you, for your client experience. And we don't think this is a good thing for JWB to manage our risk as well. And so it should be noted though, with this change, and I'll kind of go into what this means for you as a client here in a minute here, but what we're talking about simply is the timing of putting the property under contract. We are not restricting when you can buy the property, not when you can close the property. We're just simply talking about this experience of you putting it under contract 4 to 6 months in advance. We are still pumping out as many new construction homes as we possibly can, and we are going to sell those assets to you. We're just simply going to have you put them under contract when they're about 45 days out from completion. What did I miss there?
Sounds about right, man. I think you hit everything, right? Like if I can summarize, there is certain dynamics that are unique to what is happening right now, right? Starting with the market dynamics of very low supply, very high demand, driving increasing prices. You had that figured out because when you would sell a construction home, you were pricing it out to the price that you expected the completion date to happen, and you were bearing that risk. Something changed in the fact that now the Fed is signaling that interest rates are going to go up. You can't control that for a client.
Right.
And now that window becomes a risk to the client. And while you were still able to offer it, there's also construction delays, which exacerbates that risk, right?
Exactly.
So like the longer it goes, you can bear the burden of pricing it out 6 months and knowing what appreciation is going to be, but you can't really hedge for the burden of interest rates going up for the client, and then the build delays and the supply chain delays that also exaggerate the length of stay. It becomes a risk that you need to find a solution for. And your solution is now, let's reduce that time window of risk and only sell it when we're 45 days out in order to really be able to control the experience. That's what I heard.
Exactly.
Okay.
That's exactly right.
All right. So what does that mean for the client? What does that mean for me?
So what this means is that, let me just give a kind of a lay of the land right now. We have over 300 properties that are in various stages of construction as I sit here in front of you today. All of those projects are continuing to move forward as fast as they possibly can. Those projects would have been priced and would have been made available prior to this announcement of us talking about doing this, right? Those would have been assets that you could have put under contract and then waited 4 to 6 months. That will no longer be the case, but they're still moving forward. We also have existing inventory that is available right now for purchase. I just checked our inventory sheet. We have, I believe, 18 homes in inventory at the moment that are available for purchase. And so that's right there right now. There is no change to how you can put a property under contract for JWB as I sit here right now. Everything I'm sharing with you is forward looking, what to expect in the near future, because we are selling between 40 to 50 properties a month. That means putting those properties under contract with clients. As I start to look at what our current inventory is, knowing what our current demand is, if we take those 300 out of the mix, as far as what would be available to put under contract, we're going to have a waiting list in the near future, right? Demand is far greater than supply once we take those 300 out of the mix. And so sometime, what I would estimate in the next 2 to 8 weeks, we will have a waiting list at JWB, and we are going to have that waiting list until those new construction homes can be finished in a great number to outpace the demand, which will be a while, in my opinion.
Okay, so that is the big change of tune, right? Like, you thought that you were going to be able to endure this without a waiting list. The entire industry has had a waiting list now for quite some time, and you've been able to outmaneuver that. But right now there's no waiting list.
Correct.
But you are essentially looking at your months of inventory and your supply and demand. And while there's 300 plus properties in new construction that someone can lock down and buy it the same as before, you're selling 40 to 50 properties per month, which to you indicates the fact that these properties are going to get put under contract and get spoken for in the next 8 weeks or so. Why 2 weeks? Why would it be 2 weeks?
Well, what I hope is that if you're a client or a potential client and you've been thinking that investing sometime in the next 2 months or 3 months or 6 months or a year, and you've been going through those motions, what I hope you take away from everything I've shared with you here is that right now is a great time to invest, not just because of lower home prices today than in the future, not just because interest rates are lower today than they are in the future, but access to available inventory is such a benefit right now. And so what I hope is that those folks that have been thinking about doing this in 3 months, like we talked about how, low interest rates was pulling investor demand from the future when we were talking about, months of inventory. Yeah. I'm expecting that this will pull some future demand from future months when you were thinking about investing with JWB and start to purchase those properties now. I think that's the best thing for you. So if I'm looking at just what our inventory numbers are and looking at how many homes we're putting under contract, it's probably closer to 8 weeks. But when I think about, I do see some folks taking action based on this message. I think it could be as little as 2 weeks. It really is. Once that inventory gets exhausted, that's when we will need to go to this waiting list concept.
Yeah, and that makes sense. Even Denny's putting in the chat, I snagged one of those 40 after yesterday's call. Sounds like a few other folks.
Oh, that's awesome, Denny.
Right? Yeah, so people are going to take action. So it is the existing inventory that is out there right now. You're expecting supply and demand dynamics to work in speeding up, pulling forward demand. But I know that you want to talk about. Tell me about these properties that you're releasing to the public.
Yeah.
Are these new construction properties? Like, I guess tell me more about those.
Yeah. Well, part of this is, I really take it seriously that I think this show, and when you guys give me your time, I want to show up. I want to give you as much value as I can. And I also want to give you some idea of what I see coming in the future so you can be better prepared and make better decisions. I think that's the value of being here each and every week, right? And the value of the community. So with this idea, once we had this realization that a waiting list is most likely going to happen, we said, what can we do to not shock the system? What can we do to help those clients that were probably 2 months out from buying, that have been working with our team to find, handle their financing or whatever that challenge was. Maybe there are 2 months out decisions that want to be made today. How can we come up with a situation where they don't have to be met with a waiting list? And, for many of you who know JWB, we own properties in the exact same neighborhoods as our clients. We own over 300 properties in those neighborhoods. And these are the same exact assets that you guys buy on the Thursday property of the week. They're the same properties. They were built at the same time. They're managed by JWB. And so we said, well, let's release some of the properties that are in our inventory as a way to make it a smoother transition to what we see as being an eventuality, which will be this waiting list. And so what we're doing is we're releasing 40 company-owned properties. I put some of the pictures on here, if we can just kind of show that, Pablo, right? These are some of the properties that are going to be made available either now or in the coming weeks. What should jump out to you here is that they are largely built around 2015. So they are what we would call new construction. Really anything after 2014 is what we deem new construction based on lower maintenance costs. And, they're already seasoned in JWB's portfolio. I believe in them because we bought them. We built the homes on them. We have been managing the homes and the residents in there for years now. And I should point that out. They're already rented as well. So you're getting positive cash flow. So we're going to have this brief time by us releasing these properties is going to go back to the way it was like multiple years ago when you're buying an asset that's completed. As soon as you put it under contract, you work towards closing. It already has a resident in place, like the good old days. We're going to have a little bit of that time. And that's these 40 properties. And then of course, as these get exhausted, I do expect some folks to take action on these properties. As those get exhausted, plus the other properties that we have in inventory, at that point, we would then move to the waiting list. And that's why I think it's going to be sometime in the next 2 to 8 weeks.
Okay, that makes sense. So what do you see for the rest of 2022 then, man? Give us your overall kind of prediction of what's going to happen here.
I'll keep it real simple. Home prices going up. Never been more confident that home prices are going up in 2022. Interest rates are going up. I've never been more confident that interest rates are going up in 2022. The result of this is that same decision you make to buy the same property 1 year from now will have a lower return on investment than it will if you bought that property today. So if you are a client that has had a buying plan that calls for you to be purchasing properties in the next year, you should be talking to your JWB portfolio manager now and thinking about what can you do to put that same amount of capital out. This isn't about saying, hey, you got to invest more. You've already planned to do this. Speed it up. Speed it up, and it will give you a better return on your investment. Ultimately, the reason to do that is because it gets you to your passive income goal quicker, and you can start to have whatever that benefit that you've been looking for, whatever that why is that you have been looking to invest, sending your kids to college, travel fund, early retirement. You can take steps. You can take years off of doing that by taking advantage of the signals that we're seeing in the real estate market right now.
There it is, coming strong with it, man. I thought you did a really good job of summing that up. We have 6 questions. They're all kind of, I think we can answer some of these in the Facebook group if Madison can help us out and have some time. I would like to ask one by Tayo Oladipo that was asked a little earlier. I know we've discussed this previously, but can you touch on some of the perks or nuances of the Jacksonville, Florida real estate market compared to the other markets in Florida, especially in this current climate?
Yeah, absolutely. So, and I like that we're just talking about Florida specifically, right? In Florida, it's really hard to have a market that has kind of 3 components, right? Number one, it has enough people, right? Anytime you're investing in rental properties, you want to be in a market that has large economic anchors and it has over 1 million people. There aren't too many cities in Jacksonville or in the state of Florida that have over 1 million people, right? There's Miami, right? There's Tampa, there's Orlando, and there's Jacksonville. Well, out of those 4 markets, Jacksonville is the lowest price market. And if you look at that rent to price ratio, we have high rents here and we have low home prices. So out of those 4 markets, your positive cash flow in Jacksonville is going to be greater than that same type of property and that same type of neighborhood in those other markets out there. So beyond that, you then start to look at the kind of the factors of growth specific to that city. And you can start to see what businesses are coming into that city. Like for example, downtown Jacksonville represents a huge opportunity for growth for the city of Jacksonville. That's not the same opportunity that they have in Miami. Miami is largely built downtown, right? There's not much space to go. So once you kind of look at those factors for that individual city within the state of Florida, you start to see some real potential gains, even beyond just the cash flows and beyond what the normal home price appreciation would be.
Yeah, I can tell you, I know that Miami market pretty well. Right?
Yeah,
like I moved to Jacksonville because I saw the future here, and everything, like all these data points that you're saying of other markets in Florida are all very real here. As somebody living it, I look at downtown Jacksonville, and it really reminds me of downtown Miami circa like 1998. And the growth that's happened in that city, as soon as it urbanized and as soon as it created that urban core, has been exponential for real estate values and everything that's going on, and like attracting even more employers and whatnot. The dirty little secret of South Florida, which we got into the call yesterday, is this idea that, you know, people talk about sea level rise when it relates to Florida, right? And sea level rise is going to be a tricky equation because it's going to affect the world equally, but there's one place that it affects it differently. And that is below the Lake Okeechobee, we sit atop a porous limestone aquifer, and there's a like a river running underneath it. And as the ocean rises, which it's going to happen at whatever rate it's going to happen in over the next 30 years, we know how to solve for the shoreline issue, right? Like Amsterdam, New Orleans is all underwater and it's still a livable city. We know how to solve for that. The problem with the South Florida markets is that porous aquifer means that low-lying areas are actually going to be flooded from the ground up without the ocean coming in at all. So to me, one of the underreported things is once that starts, and I think we have a 50% chance that happens within 30 years, right? Like that stuff, we start seeing the real effects of that within a full market cycle, right? So like, I think one of the underreported things is as South Florida starts to suffer from these things that are completely unique that no engineer has ever solved, and unless, you know, modern science, something happens where sea level rise and climate change is reversed or whatever, I think that presents another opportunity for Northeast Florida, which doesn't have that problem, which is slightly more elevated. It doesn't have the porous aquifer, and people are going to just move north and leave the South and want to stay in a tax-free, good climate as close to where they're from state. So I don't know, you know, like for what it's worth, I like throwing that in there because if we're going to talk Florida, people tend to talk sea level rise and hurricanes.
Yeah,
so,
true.
So it's part of it.
Well, it's been your bread and butter. This was your former career.
This is my career.
You know, you saw this. So thank you for sharing that, brother.
All right. Well, GC, I think you did a really phenomenal job updating everybody here on the market. I'm super pumped that I bought 2 properties in the last year and a half.
Me too, brother.
Thanks to our runs in the morning and thanks to this environment. And I know that I've talked a lot of hot air about moving money out of my 401k and getting my 3rd property and getting it in. And, you know, it's pretty obvious that I need to take action on that right now. So I'm glad that I got to listen to this twice.
That's awesome, man.
And, you know, like I really appreciate of the 50 plus, 60 plus people that were here for this call, asking great questions. Normally we get to them throughout the call, but as we can tell, our boy had a lot to share, still went an hour and a half. And, you know, I just never goes in deaf ears that you took an hour and a half out of your day to join us, be part of the community, make friends with each other, ask great questions, to give us great context to explain it to you by. And if you're listening on the podcast or on the radio, join us on a Tuesday or a Thursday at 12:30 Eastern. Go to nyais.com and hang out, man. This is where it's at. Just put it on your calendar, let it sit there, and the day that you can make it so that we get to know you. We love meeting our new community members. I know that Madison loves welcoming them. We want to see you at the meetups. We want you to have your own nickname like all the other esteemed regulars here on the show. And this is great, man. This is now like 6 quarters that you and I have done this. So pretty awesome.
You know, I can't wait for more people to show up because I haven't met some of our folks that have nicknames like face to face, but I already have this vision of, you know, like Peter James and from the esteemed Commonwealth. I think Peter just rolls around with like a feather in his hat and being very esteemed.
If Peter doesn't show up with an ascot, I'm going to be really shocked.
We love all of you being here. I mean, it's crazy. Who spends an hour and a half out of your day, your busy days, hanging out with us each and every week? Thank you all. Thank you for giving us this platform. I really appreciate all the clients. We have folks, I think this is a great testament to the community, and then we'll peace out of here. But a lot of the same folks that heard this message yesterday are still here today.
Yeah.
Right. And they're here because of all of you. It's the community. It's that 50, 60 folks take time out of their day to spend time together. This is the value of community. And I am very, very thankful, very grateful that we get to be a part of this. So with that, you want to lead us on to Thursday or?
Yeah.
What are we doing?
Well, Thursday, we're going to go to Plum Street and show you the JWB rental property of the week. An actual home that's under inventory that we teased earlier today that will reduce an ROI if you let the interest rate go up by 1%. We're going to get into all those dynamics, fiddle with the actual deal sheet, show you how it works. And I'd be shocked if somebody doesn't buy it before then or on the call.
Somebody like you.
Somebody like Nuances.
All right, everybody. We appreciate you. We'll catch you next time.
Catch you next time. Do not be average.